When you reach 70 years old, something changes in how you think about investing. The endless pursuit of the next big winner starts to feel exhausting. The thrill of taking risks loses its appeal. What you want more than anything is certainty. You want to know that no matter what happens in the economy, no matter what chaos erupts in the markets, no matter what surprises life throws at you, your money is safe and working for you. I have been investing for over 80 years now. I've owned hundreds of different stocks over my lifetime. Some were brilliant purchases that made me fortunes. Others were mistakes that taught me expensive lessons. But through all those decades of experience, I have identified a small handful of stocks that I would never sell after 70. Stocks so exceptional, so durable, so perfectly suited for the final chapters of an investor's life that parting with them would be foolish under any circumstances. Today I am going to share 4 of those stocks with you, but more importantly, I am going to explain why these businesses are different from everything else in the market, because understanding the why is more valuable than just knowing the names. If you understand what makes a stock worth holding forever, you can evaluate any investment through that lens for the rest of your life. Let me start by telling you what I look for in a stock I would never sell, because these criteria are demanding. Very few companies meet all of them. But the ones that do are so special that selling them would be like selling a golden goose that lays eggs every single day. The first criterion is permanence. Will this business still exist and still be relevant 50 years from now? Not just surviving, but thriving. Many businesses that seem permanent turn out to be vulnerable to disruption, to technological change, to shifting consumer preferences. The companies I would never sell have demonstrated through decades of history that they possess something truly permanent, some combination of products, brands, and competitive advantages that will endure as long as capitalism exists. The second criterion is simplicity. Can I explain this business to a child? The businesses I want to own forever are not complicated. They do not depend on complex financial engineering. They do not require constant innovation to stay relevant. They do the same basic thing year after year, decade after decade, and they do it well. Simplicity means predictability, and predictability is what you want when you are 70 and cannot afford surprises. The third criterion is essential demand. Do people need what this company sells regardless of economic conditions? The best businesses serve needs that do not disappear during recessions. People might delay buying a new car during hard times. They might skip vacations and restaurant meals, but certain products and services remain in demand no matter what. Companies that serve essential needs have revenue that is recession-resistant, and recession-resistant revenue supports recession-resistant dividends. The fourth criterion is pricing power. Can this company raise prices without losing customers? Inflation is a constant threat to retirees. The dollars you saved lose purchasing power every year. The only defense against inflation is owning businesses that can raise their prices at least as fast as inflation rises. Companies with strong brands, with products that have no substitutes, with services that customers cannot easily replace. These companies can pass inflation through to customers and protect your purchasing power. The fifth criterion is financial strength. Does this company have a fortress balance sheet after 70? You cannot afford to own companies that might go bankrupt. You need businesses with low debt, strong cash flows, and the financial resilience to survive anything. Companies that can keep paying dividends even during severe recessions. Companies that do not need to raise capital at bad times at bad prices. The sixth and final criterion is shareholder orientation. Does management treat shareholders as partners? Some companies generate enormous profits but waste them on foolish acquisitions, excessive executive compensation, or empire building that destroys value. The companies I want to own forever return excess cash to shareholders through dividends and buybacks. They allocate capital wisely. They treat my money like their own money. Very few companies meet all 6 of these criteria, but the 4 I am about to share with you meet every single one. These are businesses I would hold through market crashes, through recessions, through wars, through pandemics, through anything. Because I know with very high confidence that they will still be generating profits and paying dividends long after I am gone. The first stock I would never sell after 70 is Coca-Cola. I first bought Coca-Cola stock in 1988, and I have never sold a single share today. The dividends I receive from Coca-Cola each year exceed my entire original investment. That is the power of owning a great business for a long time. Let me explain why Coca-Cola meets all 6 of my criteria for a stock I would never sell. Permanence Coca-Cola has been selling essentially the same product for over 130 years. The formula has barely changed. The brand has only gotten stronger. Think about what the world looked like in 1886 when Coca-Cola was invented. There was no radio, no television, no internet, no automobiles, no airplanes. The world has transformed completely multiple times over. And through all of it, people kept drinking Coca-Cola. That is permanence. That is a business that will exist as long as human beings exist. Simplicity, what does Coca-Cola do? They make beverages, they mix ingredients together, put the liquid in bottles and cans, and sell it to people who want something refreshing to drink. A child can understand this business. There is no complexity, no black box, no technology that might become obsolete. They make drinks. They have made drinks for over a century. They will make drinks for the next century. Essential demand. Now, you might argue that Coca-Cola is not essential in the way that medicine or electricity is essential. People do not need soda to survive. But here is what I have learned over decades of studying consumer behavior. Coca-Cola has become essential to the daily routines of billions of people around the world. It is part of meals, part of celebrations, part of how people reward themselves for getting through another day. That emotional connection creates demand that is remarkably stable through economic cycles. During recessions, people might skip expensive dinners out, but they still buy a Coke at the grocery store. It is an affordable luxury that people refuse to give up. Pricing power. Coca-Cola can raise prices and people keep buying. They have demonstrated this over and over throughout their history. When input costs rise, when inflation appears, Coca-Cola raises prices. Customers grumble, but they pay. Because there is no substitute for a Coca-Cola. Pepsi is not the same. Generic cola is not the same. The brand commands a premium that allows pricing power that few companies possess. Financial strength. Coca-Cola generates enormous free cash flow, over $10 billion per year. They have an investment-grade credit rating. They have manageable debt levels. They could pay their dividend for years even if they never sold another bottle. That financial strength means the dividend is secure. It means the company can survive anything. Shareholder orientation. Coca-Cola has paid a dividend every year for over 100 years. They have increased that dividend for 62 consecutive years. Management understands that the dividend is sacred. They return billions to shareholders every year through dividends and buybacks. They treat shareholders as the owners they are. When I look at Coca-Cola, I see a company that will be paying me growing dividends for as long as I live and then paying dividends to my heirs after I am gone. Why would I ever sell something like that, no matter what happens in the markets, no matter what the economy does? Coca-Cola will keep selling drinks and returning cash to shareholders. That certainty is priceless after 70. The second stock I would never sell after 70 is Johnson & Johnson. This company has been a cornerstone of my thinking about what makes a truly permanent business. Let me walk through my 6 criteria. Permanence. Johnson & Johnson has been in business since 1886, the same year Coca-Cola was founded. For nearly 140 years, they have been helping people stay healthy. They sell pharmaceuticals that treat diseases. They sell medical devices that enable surgeries. They sell consumer health products that have been trusted for generations. Healthcare is one of the most permanent industries imaginable. As long as human beings get sick, as long as we want to live longer and healthier lives, there will be demand for what Johnson & Johnson sells: simplicity. Johnson & Johnson does 3 things. They make drugs, they make medical devices, They make consumer health products like Band-Aids and Tylenol and Listerine. Each of these businesses is easy to understand. There is no complexity, no financial engineering, no business model that requires a PhD to comprehend. They make products that help people feel better. They have done this for almost 140 years. Essential demand. Healthcare is as essential as it gets. When you are sick, you buy medicine. When you need surgery, you get the procedure. When your child scrapes their knee, you reach for a bandage. These are not discretionary purchases that get postponed during recessions. Healthcare spending actually tends to increase during economic downturns as stress-related illness rises and people prioritize their health over other spending. Johnson & Johnson serves a need that is recession-proof pricing power. Johnson & Johnson's pharmaceutical products are protected by patents. Their consumer brands have earned consumer trust over generations. When Johnson & Johnson raises prices, customers pay because there are no good alternatives. Their Band-Aid brand has been the leading bandage for over 100 years. Their Tylenol brand dominates pain relief. That brand equity translates into pricing power that protects margins through any economic environment. Financial strength. Johnson & Johnson is one of only 2 companies in America with a triple credit rating. Their credit rating is higher than the United States government. They generate over $20 billion in free cash flow annually. Their balance sheet is a fortress. They could pay their dividend for years without earning another dollar. That financial strength means the dividend is as secure as any dividend in the world. Shareholder orientation. Johnson & Johnson has increased its dividend for 62 consecutive years, 62 years of uninterrupted dividend growth through recessions, through wars, through financial crises, through pandemics. Management treats the dividend as a sacred commitment. They return enormous amounts of cash to shareholders every year. When I think about what I want to own after 70, Johnson & Johnson is the perfect example. A business so essential, so durable, so financially strong that I never have to worry about it. The dividend will keep coming and keep growing regardless of what happens in the world. That is the kind of certainty that lets you sleep soundly at night. The third stock I would never sell after 70 is Procter & Gamble. This company sells products that are so embedded in daily life that most people do not even think about them. And that invisibility is exactly what makes it so valuable. Permanence Procter & Gamble has been in business since 1837. That is nearly 190 years of continuous operation. They have survived the Civil War, 2 world wars, the Great Depression, and every recession and financial crisis in American history. The products they sell, soap, toothpaste, laundry detergent, diapers, shampoo, these are products that human beings have needed for centuries and will need for centuries to come. The specific brands might evolve, but the underlying needs are permanent: simplicity. What does Procter & Gamble do? They make household products, things you use every single day without thinking about them. Tide for your laundry, Crest for your teeth, Pampers for your baby, Gillette for your face. These are simple products that meet simple needs. There is nothing complicated about Procter & Gamble's business model. They make stuff that people need. They sell it to them, and they have been doing this successfully for almost 2 centuries. Essential demand. The products Procter & Gamble sells are not optional. People do not stop washing their clothes during recessions. They do not stop brushing their teeth when the economy slows down. They do not stop buying diapers for their babies regardless of what the stock market is doing. This creates demand that is remarkably stable through economic cycles. Revenue might dip slightly during hard times as consumers trade down to cheaper alternatives, but it never collapses. People need these products' pricing power. Procter & Gamble's brands command premium prices. Tide costs more than generic laundry detergent. Crest costs more than store. Brand toothpaste, Gillette razors cost more than disposable alternatives. Consumers pay these premiums because they trust the brands, because they have used them for years, because they believe the quality justifies the price. That brand-based pricing power allows Procter & Gamble to pass inflation through to consumers and protect their margins. Financial strength. Procter & Gamble generates over $15 billion in free cash flow annually. They have an investment-grade credit rating. Their debt levels are manageable. They have the financial strength to maintain and grow their dividend through any economic environment. The balance sheet is solid. Shareholder orientation. Procter & Gamble has paid a dividend every year since 1890. That is 134 consecutive years of dividend payments. They have increased the dividend for 68 consecutive years, making them a dividend king with one of the longest streaks of dividend growth in the entire stock market. Management understands that shareholders depend on that income and treats the dividend as an inviolable commitment. For someone over 70, Procter & Gamble offers exactly what you need. Predictable revenue from products people cannot stop buying. Pricing power that protects against inflation. Financial strength that ensures the dividend will keep coming. A management team committed to returning cash to shareholders. Why would you ever sell a business like that? The fourth stock I would never sell after 70 is Apple. Now, I know some of you might be surprised by this choice. Apple is a technology company, and technology companies are supposed to be risky, subject to disruption, constantly needing to innovate to stay relevant, but Apple is different. Apple has transcended technology to become something more permanent. Let me explain why Apple meets my criteria. Permanence. Apple has built something that very few technology companies have ever built. An ecosystem. Over 1 billion people carry an iPhone. Those people also own AirPods, Apple Watches, MacBooks, and iPads. They store their photos in iCloud. They buy apps from the App Store. They pay with Apple Pay. Everything works together seamlessly. And once you are in the Apple ecosystem, switching to something else is incredibly painful. You would lose years of photos, messages, and apps. You would have to relearn how to do everything. You would leave behind devices that no longer work as well without the iPhone at the center. This ecosystem creates permanence that typical technology companies do not have. Apple customers stay Apple customers. Their children become Apple customers. The ecosystem perpetuates itself. Simplicity. Apple makes devices and services. They make phones, tablets, computers, watches, and earbuds. They sell subscriptions to music, television, and cloud storage. Every single thing Apple does is easy to understand. There is no complex financial engineering. There is no business model that requires deep technical expertise to comprehend. They make beautiful products that people love using, and they charge premium prices for them. Essential demand. The iPhone has become essential to modern life. People use their phones for communication, navigation, banking, entertainment, work, and 1,000 other daily activities. Try going a week without your smartphone and you will understand how essential it has become. This is not demand that disappears during recessions. People might delay upgrading to the newest model, but they keep their phones and they keep paying for the services. Apple services revenue in particular is remarkably recession resistant because it is based on subscriptions that people are reluctant to cancel. Pricing power. Apple charges more for their products than any competitor. An iPhone costs more than a Samsung phone. A MacBook costs more than a Dell laptop. AirPods cost more than other earbuds. Yet people gladly pay the premium because they value the quality, the design, the integration, the status. Apple has more pricing power than any other technology company in history. When their costs rise, they raise prices. Customers pay financial strength. Apple generates over $100 billion in free cash flow annually. $100 billion. That is more cash than most countries produce. They have over $60 billion in net cash on their balance sheet. They could buy most companies outright without borrowing a dime. This financial strength is unmatched. Apple could pay their dividend for decades without earning another dollar. Shareholder orientation. Apple returns enormous amounts of cash to shareholders through dividends and buybacks. They have repurchased hundreds of billions of dollars of their own stock over the past decade, reducing the share count and increasing each remaining shareholder's ownership of the business. Management treats shareholders as true partners and allocates capital wisely. I have said many times that the iPhone might be the best business I have ever seen. The combination of loyal customers, recurring revenue, enormous profit margins, and incredible financial strength is remarkable. Apple is not a typical technology company. It is a consumer products company with technology advantages that create switching costs competitors cannot replicate. Now let me talk about what these four companies have in common and why that matters for anyone over 70. All four of these businesses generate enormous amounts of free cash flow. Coca-Cola, Johnson & Johnson, Procter & Gamble, and Apple together produce well over $150 billion in free cash flow every year. That cash is the lifeblood of your dividend income. As long as these companies keep generating cash, they will keep paying and growing their dividends. All four of these businesses have pricing power that protects against inflation. When you are 70, you might live another 20 or 30 years over that time. Inflation will erode the purchasing power of every dollar you own, but these four companies can raise their prices to keep pace with inflation. Your dividend income will grow at least as fast as your cost of living. All four of these businesses have fortress balance sheets. They can survive recessions, financial crises, pandemics, anything the world throws at them. They do not need to cut their dividends to preserve cash. They do not need to raise capital at bad times at bad prices. They are financially bulletproof. All four of these businesses have demonstrated through decades of history that they treat shareholders well. They pay dividends. They grow those dividends. They buy back shares. They do not waste money on foolish acquisitions or excessive compensation. They understand that they are stewards of their shareholders' capital. When you own these four stocks, you own businesses that will keep working for you no matter what happens. The market might crash, the economy might enter recession, a pandemic might shut down the world. Through all of it, Coca-Cola will keep selling drinks. Johnson & Johnson will keep making medicine. Procter & Gamble will keep producing household essentials. Apple will keep selling phones and services, and all of them will keep paying you dividends. That is what you want after 70. Not excitement, not the possibility of doubling your money, not the thrill of finding the next big winner. You want certainty. You want income you can count on. You want businesses so durable that you never have to worry about them. Let me share some thoughts about how I think about selling, because the decision to never sell is not something I take lightly. There are legitimate reasons to sell a stock. If the business fundamentally changes for the worse, if management becomes untrustworthy, if a better opportunity comes along that is dramatically more attractive, if you need the money for something important. But when you own businesses as exceptional as these four, those reasons rarely apply. The businesses do not fundamentally change because they are built on permanent foundations. Management tends to be trustworthy because the corporate cultures select for integrity. Better opportunities are hard to find because these are among the best businesses in the world. And if you need money, you can sell a small portion while keeping the majority of your position. The decision to never sell is really a decision to avoid the mistakes that come from constant activity. Every time you sell a stock, you pay taxes on your gains. Every time you sell, you have to find something better to buy with the proceeds. Every time you sell, you risk making an emotional decision based on short-term market movements rather than long-term business fundamentals. By committing to never sell these four stocks, I remove the temptation to tinker, to trade, to try to time the market. I own great businesses. I collect my dividends. I let compound interest do its work, and I sleep soundly at night knowing that my money is in the best possible hands. For someone over 70, this peace of mind is worth more than any trading profits. You do not want to spend your retirement watching stock tickers and worrying about the market. You want to spend your retirement living your life knowing that your investments are taking care of themselves. So if you are over 70 or approaching 70, consider building a portfolio around businesses like these. Permanent businesses selling essential products with pricing power and fortress balance sheets, run by management teams that treat shareholders as partners. You might not own these exact 4 stocks. The specific names matter less than the characteristics they represent. But if you do own Coca-Cola, Johnson & Johnson, Procter & Gamble, and Apple, hold on to them. Do not sell them because the market is down. Do not sell them because some analyst issues a negative report. Do not sell them because you think you see a better opportunity. These are businesses worth owning for life. The dividends will keep coming, the businesses will keep thriving, your wealth will keep growing, and you will have the certainty and peace of mind that every retiree deserves. That is what it means to own stocks you would never sell. Not blind loyalty, not stubbornness, just the recognition that some businesses are so exceptional that selling them would be foolish. Find those businesses, own them, keep them forever. Your future self will thank you. Let me go deeper on why the commitment to never selling these stocks is so powerful. Because I think many investors underestimate the costs of selling and the benefits of permanence. Every time you sell a stock, you trigger a taxable event. If you have held a stock for decades, as I have held Coca-Cola, the capital gains can be enormous. Selling would mean giving a significant portion of your gains to the government immediately, rather than allowing that money to continue compounding for you. The tax drag from frequent trading can reduce your long-term returns by 1 or 2% per year. Over decades, that adds up to a staggering amount of money. Beyond taxes, there is the reinvestment problem. When you sell a stock, you have to do something with the proceeds. You have to find another investment, and finding investments as good as these 4 companies is extraordinarily difficult. Most of the time, when investors sell a great business and buy something else, they end up in something worse. The grass looks greener elsewhere, but it rarely is. I have made this mistake myself over the years. I sold great businesses too early because I thought I saw better opportunities elsewhere. Almost always, I would have been better off holding what I had. The businesses I sold kept compounding. The businesses I bought instead often disappointed. The lesson I learned was that when you own something truly exceptional, the burden of proof should be on selling, not on holding. There is also a psychological benefit to the commitment to never sell. When you know you are going to hold a stock forever, you stop worrying about short-term price fluctuations. You stop checking the stock price every day. You stop reacting to every piece of news. You become a true long-term investor rather than a short-term trader. This mental peace is worth something after 70. You should be enjoying your retirement, spending time with family, pursuing hobbies, traveling, living life. You should not be glued to financial news worrying about whether to sell your stocks. By committing to never sell these 4 businesses, you free yourself from that anxiety. Your investments are sound. The dividends will keep coming. You can focus on what really matters. Let me also address what happens during market crashes, because this is when the commitment to never sell is tested most severely. I have lived through 14 major market crashes. In every single one of them, there were compelling reasons to sell. The news was terrifying. The losses were painful. Experts were predicting even worse to come. The temptation to sell, to get out, to protect what was left, was overwhelming. But in every single crash, selling would have been the worst possible decision. The people who sold at the bottom of the 1974 bear market missed the great bull run that followed. The people who sold during the 2008 financial crisis missed one of the greatest recoveries in market history. The people who sold during the 2020 pandemic crash missed the fastest bear market recovery ever. If you own Coca-Cola, Johnson & Johnson, Procter & Gamble, and Apple, you do not need to sell during crashes. These businesses will survive. They have survived every crash in history. Their dividends will continue. The stock prices will eventually recover and reach new highs. All you have to do is nothing. Just hold on. The commitment to never sell is what gives you the strength to do nothing, when doing nothing is the hardest thing in the world. Now, let me share some additional thoughts about each of these 4 companies and why I am so confident in their futures. With Coca-Cola, people sometimes worry that changing health consciousness will hurt demand for sugary beverages. This concern has existed for decades, and Coca-Cola has adapted by diversifying into water, juice, tea, coffee, sports drinks, and other categories. They are no longer just a soda company. They are a total beverage company with products for every taste and health preference. As developing countries grow wealthier and their middle classes expand, Coca-Cola's addressable market keeps growing. There are billions of people around the world who will discover the pleasure of a cold Coca-Cola as their incomes rise. The growth story is far from over with Johnson. And Johnson, the aging of the global population, creates tailwinds that will last for decades. As people get older, they consume more health care. They need more pharmaceuticals, more medical procedures, more consumer health products. The demographic wave of aging baby boomers and their counterparts around the world will drive demand for everything Johnson & Johnson sells. Their pharmaceutical pipeline continues to produce new drugs that address unmet medical needs. Their medical device business benefits from technological advances that enable new procedures. The future for Johnson & Johnson is very bright. With Procter & Gamble, the story is similar. Global population growth and rising living standards create more customers every year. People in emerging markets are discovering brands like Tide and Crest and Gillette as they move into the middle class. Procter & Gamble has barely penetrated many of the world's largest markets. The growth opportunity is enormous. And in developed markets, Procter & Gamble benefits from the trust they have built over generations. When a new parent needs diapers, they reach for Pampers because that is what their parents used. Brand loyalty perpetuates itself across generations. With Apple, the ecosystem only gets stronger over time. Every new device Apple sells reinforces the connection to every other Apple device. Every new service Apple launches gives customers another reason to stay. The switching costs grow higher every year. And Apple is still in the early stages of penetrating enormous markets. Their services business is growing rapidly. Their wearables business is growing rapidly. Their potential to enter new categories like augmented reality, autonomous vehicles, and healthcare is significant. The Apple of 10 years from now will be even more dominant than the Apple of today. All four of these companies share another trait that I have not mentioned yet. They attract and retain excellent managers. The best business school graduates want to work at these companies. The best executives compete for leadership positions. This creates a virtuous cycle where excellent people attract more excellent people, and the quality of management stays high generation after generation. This matters because even the best business can be ruined by bad management. But when a company has a reputation for excellence, when working there is considered a career achievement, when the culture reinforces the values that made the company successful, management quality becomes self-sustaining. You do not have to worry about the next CEO being a disaster. The system selects for competence. Let me also talk about how these four stocks work together in a portfolio, because diversification matters even when you own excellent businesses. Coca-Cola is a consumer staples company that sells beverages. Johnson & Johnson is a healthcare company that sells pharmaceuticals, medical devices, and consumer health products. Procter & Gamble is a consumer staples company that sells household products. Apple is a technology company that sells devices and services together. They provide exposure to different sectors of the economy. If healthcare faces challenges, Coca-Cola, Procter & Gamble, and Apple keep performing. If technology faces challenges, the other three keep performing. If consumer spending weakens, the essential nature of these products limits the damage. No single risk factor threatens all four companies simultaneously. At the same time, all four companies share the characteristics that make them appropriate for a retiree. They all pay dividends. They all have pricing power. They all have fortress balance sheets. They all have durable competitive advantages. So you get diversification across sectors while maintaining consistency and quality. This is the ideal construction for a portfolio after 70. Different businesses that reduce concentration risk, but all meeting the same high standards for permanence, simplicity, essential demand, pricing power, financial strength, and shareholder orientation. I want to close with some thoughts about the relationship between patience and wealth, because the decision to never sell is ultimately a decision to be patient, to let compound interest work over long periods of time, to resist the temptation for action when inaction is the wiser choice. Most investors sabotage themselves through impatience. They buy and sell constantly. They chase whatever is hot. They panic when markets fall. They get greedy when markets rise. All of this activity feels productive, but it is actually destructive. Every trade is cost. Every decision creates opportunities for error. The more active you are, the more likely you are to hurt yourself. The wealthiest investors I have known are the most patient ones. They find great businesses, they buy at reasonable prices, and they hold forever. They do not react to headlines. They do not adjust their portfolios based on economic forecasts. They just own great businesses and let time do the work. After 70, this patient approach is more important than ever. You have accumulated wisdom over a lifetime. You have seen markets rise and fall. You understand that short-term fluctuations are noise and long-term business performance is signal. Use that wisdom, commit to patience. Own these 4 stocks and never sell them. The dividends will compound, the businesses will grow, your wealth will increase, and you will have the peace of mind that comes from knowing your financial future is secure. That is my message to you today. If you are over 70, build your portfolio around businesses like Coca-Cola, Johnson & Johnson, Procter & Gamble, and Apple businesses that meet the highest standards for quality and durability. Businesses that will pay you growing dividends for the rest of your life. Businesses that you never have to worry about, never have to sell, never have to second guess. Own them, hold them, keep them forever, and enjoy your retirement knowing that your investments are working for you every single day, without any effort or anxiety on your part. That is the reward for decades of saving and investing wisely. A portfolio of exceptional businesses that takes care of you for the rest of your life.